Hi everyone. So wanted to welcome everyone to this week's or this month's, I should say, and probably the first of the year, I think it is, webinar. Hope everyone had a lovely sort of Christmas time, New Year, and we got some good news yesterday with the lifting of the lockdown eventually, even though it seems a bit of a long drawn out process, but hopefully not too long until we're all back to some sort of normality. So what we're going to cover, guys, in this particular webinar is going to be sort of a bit of a recap on 2020, what happened to the property market, what the changes were, what was expected, and what actually happened, and then moving on to 2021, what we can expect over the next 12 months. So, without further ado, let's talk about 2020. Now, obviously, we know what happened in terms of the COVID level, but for many of us out there, we still get asked questions how the property market performed and what it did. Now, the reality is no one predicted what was going to happen, both from the point of view of the pandemic and from the economic fallout. Now, if we look at the initial figures, we predicted a rise in 2020. We did a webinar, which is probably still on our website last year, of around about 3 to 4% for both Manchester and Liverpool, and London to be flat in the region of sort of like 0.5% decline, give or take, at worst 1% decline in London, and as a country as a whole to rise around 2%. Then we started to hear murmurs of COVID. At the end of February last year, a number of newspapers were reporting that out of a wet market in Wuhan, this potential virus was spreading around the globe. Then we kind of caught wind of a potential lockdown. And of course, this then happened. And within days, we saw the stock market plunge from 7,500 points, under 5,000 points, just under it was. Trillions was wiped off the stock market in one day in particular. And investors lost, I think, in one particular day, I think it was 125 billion in one particular day. The predictions then were coming out about in regards to the property market. We had a number of analysts and even the Bank of England were talking of a drop, anything between 5 to 30% drop. Now, 30% was a drop predicted by the Bank of England, which we've said on webinars before, which was a shocking prediction. I mean, that is frightening that the Bank of England can get it so vastly wrong. But as we've said before, what they like to do is predict or overestimate the drop, and then when it doesn't drop that much, they say, well, it's because we saved it. In regards to the predictions, the majority, 90% plus of analysts or agents were saying there was going to be a drop. We never thought there was going to be a drop because there was nothing to really put people off the market. It was just that they couldn't do anything. It becomes static. So obviously, we put here, we don't like to brag, but of course we're obviously going to say what we said. The reality is that we said it won't happen. We hosted a webinar in April, May time, still available online, and we said that the main fundamentals, which we always talk about in every webinar, of taxation, legislation, and interest rates, haven't changed. So the reality is, if the major fundamentals don't change, the property market doesn't. We always anticipated that it was going to recover nicely once lifted because there was just a lot of pent-up demand. But what then happened, if honest, we didn't predict. We thought it would just get back to a bit of normality, but we certainly didn't predict what happened next. And that was a culmination of factors. It boomed. We saw a huge amount of pent-up demand, which we knew was we knew was there because we knew even from our own agency, we knew how many people were requesting information. We went from having only a few people request information the week after lockdown to hundreds of people requesting information on different properties. But what the big difference was is they weren't comfortable with moving forward yet. So the people that did move forward at the time, they got an absolute bargain because developers were giving big discounts. But for the people that didn't move forward, we knew that there was going to be a lot of pent-up demand. So when the cork was taken off, everything would just flow. Now, what then happened, the Chancellor decided to put a stamp duty holiday on, which it simply added fuel to the fire. It was still going great guns before that, but that just added fuel to the fire. And due to this, we've seen the biggest increase in the growth since 2016. Some cities, as you could probably see in the corner there, some cities, Liverpool, Manchester, we're hitting sort of over 6% growth. Now that is not heard of typically year on year. As I say, it happened in 15, 16, but we certainly didn't anticipate it was going to be in 2020. And you can see right the way down the list, the majority of those cities in North, Liverpool, Manchester, Nottingham, Leeds, Leicester, Sheffield, right the way through. The only one that dropped, which isn't on that list, was Aberdeen, I believe it was, off the top of my head. But as I say, overall, the UK market went up 4.3%, and of course, the cities that we recommend, the Liverpools, the Manchester of the world, went up over 6%. So we made great gains. For anyone that invested with us over the years, they had a bumper year. Rents were stable, and there was a lot of talk about people vacating cities and looking in the suburbs. That didn't happen. For the kind of developments that we deal on, that didn't happen. We understand why it would happen in London. If you've typically got someone who's living in potentially a really small apartment in London, and that apartment costs sort of 600,000-700,000 for a one bed, and in an area which is just an average area, the reality is they will have gone to the suburbs and bought a 3-4 bedroom house with a garden. But typically in Manchester, we didn't see that. Demand was as high as ever. We actually had a development called the Loom, which completed during lockdown, and we got that fully let. So we didn't have any issues with letting city centre. So in regards to the year, as I say, as a whole, we didn't predict what was going to happen. We predicted a rise, but we certainly didn't predict a rise of 6-7% plus. However, there are also negatives. The negatives are due to the fact that solicitors have had to start to work from home. The reality is the speed is diabolical. Whereas typically we would get transactions exchanged within weeks, maybe 4 to 6 weeks, we're now looking at 5 months. So transactions, we've still got transactions outstanding from the start of last year, where people have simply just not been able to get the answers that they need from the solicitors. So everything has really slowed down, and that's a really big stumbling block. Solicitors are busier than ever. Then as I say, they're working from home. They're not at their normal systems, and I'll be honest, solicitors on a Friday, you'd be lucky to get hold of them past 3 o'clock. And the reality is now you're probably lucky to get them hold of them past 12 o'clock on a Friday, but that's another story. But the reality is that we're working on ways to speed things up, in terms of which we're trying to integrate them more into our software to get everything sped up at the start. But we still know that even if you're looking to buy now, we're probably not going to exchange for a good sort of 3 to 4 months on average. So moving forward to 2021, where we are today. Now, it will always be predicted that the investment market falls, whether it's the property market or the stock market. You're always going to find that the negative reports outweigh the positive. That's standard. Every single year, the negative will outweigh the positive. But when we look behind the reports, the simple fact is we have to look at the facts. So the stamp duty, we know that in some point in time, stamp duty will have to come to an end. Now, I'm going to be very surprised if it comes to an end right at the end of March this year. I will be shocked if they just said, you know what, we're going to end it. There's been talk from solicitors that they're going to say that anything that's exchanged can still benefit from the stamp duty holiday. There's been talk that they're going to extend it for 6 to 8 weeks. But the newspapers are saying, well, whenever it ends, there's going to be a cliff edge. Now, we don't think that's going to happen, because the average price of a property is just over the 200,000 mark, and people save £1,750 based on that house price. So we don't feel that that's a make or break. You're talking about £1,750. People aren't going to forego all of the money that they've already spent. They've already spent money on lawyers. They've already spent money on mortgages. They're not going to suddenly stop buying that house just to save £1,750. Where it will store things is around about the £500,000, £450,000 to £500,000 level. because at that level you're saving anything between £13,000 to £15,000. So then that brings us back into the London bracket, or just on the outskirts, where you've got those particular properties and you've got someone who's, simply can't exchange in time or can't complete in time, and they're going to lose 15,000, they will pull out. So we feel that market is going to dip. So anything in London, we feel London's going to have a bit of a struggle of a year. Other benefits that London had before is overseas investors would be buying. So therefore, they would be looking closely at the exchange rate. Exchange rate is now gone against them. And we've been saying for years, get in the property market while the exchange rate is great. Because the reality is that exchange rate, once Brexit ends, and again, we've done webinars on this before, once Brexit ends, the pound will get stronger, which it's proven to be. So at the time back in Brexit, we're looking at the pound is 123, 124 to the dollar. And you're now looking at in the region of sort of late 130s, 140s. So, that's something that is going to impact London as well, especially when we compare it to the Asian currencies. And we just feel that at that level, the 450 to 500, the saving of 15,000, they might suddenly just throw in the towel because, they might have only spent 1,500 to 2,000, so they might throw in the towel. So the reality is that in regards to 2021, although that we've got stamp duty falling off, we don't feel that the markets that we aim at are going to be impacted in a negative way. We also got to look at what people have financially. Now, when this article was written, the Bank of England announced that there was 100 billion extra in savings. They've recently come back and they've recently announced that actually this is closer to 250. So £250 billion extra. Now that's an accumulation of things. We've obviously had mortgage holidays. So people have managed to save a little bit more that they haven't had to spend on a mortgage. People have been furloughed. The majority of people have been furloughed at 100%, where companies have topped up their salary rather than the 80%. Companies have had bounce back loans. And the majority of people haven't had to commute. Commuting takes a big chunk, especially when you're commuting into from quite far away outside city centres. Even where I am, which is only 35-40 minutes from London, it's probably 4,000 or 5,000 for a season ticket. Plus, on top of that, you're talking about just little things. Could be daily lunch, daily coffees. Save £10 a day over the period of a month. That's an extra £200 a month saving. 2,500 a year for two people. That's £5,000 saving. People aren't eating out in restaurants, saving money. People haven't been going on holidays. So what that's meant is the majority of people, not all, but the majority of people who have saved money have actually just banked it. So they're saying that there's an extra 250 billion. Now, so there's no reason why that won't be let off the leash. Now, we saw today that an announcement from TUI said that they said from their holidays, they've had their best day yesterday, and it was yesterday afternoon, actually, in a month. So we know that there's a lot of pent-up demand for things like holidays, leisure. And again, it's going to be the same with property. Investors will actually look at their bank and think, do you know what? If I've saved 20, 30,000 over the last 12 months, which is potentially what some people have saved, the reality is that they might then go and look at doing an investment. So the UK is looking at a V-shaped recovery. Again, we know that we've got a long way to go in terms of getting fully recovered, but this is looking at a V-shaped recovery. And if it does, we see that there's no reason why that the property market will actually stall. So then a lot of questions we get asked is, will we see the same kind of returns and gains as we did last year? So if I invest now, am I going to get another 6 to 7% growth? The answer is no. We have to be more conservative. We just can't see there being another 6, 7% growth. We can't see that pent up demand again, because the property market has remained open during this lockdown, whereas the first lockdown it was closed, so there was pent up demand. This lockdown it's remained open, so we've still been able to do viewings, we've still been able to go into the office, and due to that we see things are just going to tick over this year. So for the top cities like Manchester, Liverpool, Leeds, we do still see circa 4%, maybe slightly under or slightly over for some of the cities. We still see that 4% mark, so we still see a good return on your money. And we still see that if you put your income on top of that, if you've got 6% gross income, then you're still going to make the 10% a year, which is far better than most other investment vehicles out there. So we still feel it's a great time to invest in property. But Again, we're not going to see the kind of growth margins that we saw last year. So we do have to go back to being extremely picky, getting as much discount as we can when we go to those developers. And where we've been really excelling recently is where we've actually accumulated a number of deals and we put them through all at the same time. So let's say we've got, for example, 8 to 10 deals to go through. We wait until we've got that figure and we go to the developer, we ask for a discount on all 10 of them, and we get a far better discount doing it with that model. And because of that, we've managed to get some really strong discounts towards the back end and last year and the beginning of this. Now, one thing that has changed in London, because we're always paying close attention to London, is opportunities. There's a couple of opportunities that we've noticed around Zone 4, both East and West London, 20 minutes from Central. We've got certain developers who at one point in time, they got carried away with purchasing land, and they're now building, and they need to shift the units. The reality is that they've still got to pay back loans, they've still got to pay back money to the bank, so they now need to shift their units, and a lot of them have discounted the units. We've got 2 developments in particular, one in Hackney, one in Hounslow, where we feel that there are great below market value opportunities. So there are still opportunities in London to be had. And as I say, in London, if we can get things for below the 300,000 mark, which we're getting in Hounslow with only a 10% deposit, that's something where we feel is going to be a really strong market, especially as neighbouring developments are 50, 60,000 pound more. So to summarise, guys, as I say, we don't feel it's going to be a year like last year, but we also don't feel we're going to have the negatives of last year as well, where we couldn't do viewings and the property market closed. Construction is fully open. A number of sites have had delays because the reality is construction companies had to finish previous sites before they moved on to the new sites. So we've noticed a few things there. So construction has been delayed for longer than we anticipated. But all in all, the property market's open, and we feel it's going to be another strong year. In terms of, a lot of people have also asked, well, when do we think it's going to fall? Well, again, it can't keep going up. It can't keep outstripping wages. So what will happen is more people will rent. You'll have more of the wealthy buy, and we'll become a nation of renters. That's the reality. It's the way it's going. But we do feel that as if inflation starts to kick in, if we have a really big recovery and inflation starts to kick in, then the Bank of England might have to increase interest rates to curb that. That's when we feel that things might start to sort of slow down. But we're not anticipating that for a number of years yet. So at the moment, we're still anticipating solid returns. And as I say, as long as we get the right property and the right property at the start. So now over to you guys. Again, you should have sort of like a question or speech bubble. Are there any questions that we can help with at all? This webinar, by the way, is going to be on our website within the next sort of 4 to 5 hours, so you can watch this again. We will send this out to everyone. So if there are any questions that you think of after the event, as I say, when we send this out to you, just reply to that email, and we can answer any questions you might have. So I've got a question here. Why did the property market jump so much last year? Okay, so in regards to last year, it was mainly due to the pent-up demand. And what happens is you tend to find a lot of people, it's that herd mentality. So as soon as the newspaper reports that the property market is going to go down, no one buys. But as soon as people feel that the property market is going to actually increase, then it's that herd mentality. Everyone thinks, well, I better get in before the next person. We saw it with, as ridiculous as it sounds, we saw it with pasta and toilet rolls. It's a herd mentality. So as soon as the newspaper reports we might run out of toilet roll, everyone goes and buys toilet roll or pasta, whatever it may be, and it's a self-fulfilling prophecy. So the reality is that that's what we saw in the property market last year. Everyone was talking about, get on board the property market before it spirals out of control, and then it becomes a self-fulfilling prophecy. That's the main reason. And there was a lot of, as I say, pent-up buyer demand back in March of last year. So what's my prediction for London house prices in 2021? So difficult to, without you saying what area of London, it's difficult to pinpoint. My prediction is I feel they're going to be pretty static. The two main reasons, unless you can find a bargain in London, I probably wouldn't be advising it. Two main reasons, and that's from an investment point of view. Is first of all, you tend to find that the property prices are far more expensive, therefore you're paying far more stamp duty. For example, if you go and I'm assuming here that if you're buying something, it will be after the stamp duty ends. So let's assume that if you go and buy a £500,000 unit and you pay a really big chunk of stamp duty, you go and pay 15,000 stamp duty if it's a first time buy, or a lot more if it's a second property. The reality is that it takes you 18 months to break even, because that stamp duty, that tax, is dead money. So you're never going to get that back. So typically in London, from an investment perspective, you're going to have to rent that for 18 months solid before you get to the break even stage. But also, if you don't buy it within a limited company, you're also going to be paying tax on that gross income, not the net income, the gross income. So again, it might even take you 24 months to get there. So my prediction is a lot of people don't look towards London to invest. A lot of the savvy investors will head further up north. However, the people that we have seen invest in London, for example, especially from the Asian markets, we've seen a lot of Chinese, a lot of clients from Hong Kong, even people in UAE, Middle East. They have invested, but that's because they were benefiting hugely from a very weak pound. Now that pound has got stronger, my gut feeling is that we're not going to see much of a rise in London, if anything. I think it's going to be pretty static, to maybe even falling slightly. So I think that London will be affected by the stamp duty holiday ending. It has already been affected by overseas buyers not buying as much as they did. So I don't see the London market being that strong. The only way to buy in London is if we've got something which is 40, 50,000 below market value. And as I say, we're in some of the outer zones, zone 3, zone 4s, and we've got a bargain there, 100%. It's still worth moving with. It's London, it will still let, and it's still strong in the letting side, but I still feel that the prediction is that it will slightly fall. And also commercial properties, whereas people, London will bounce back in regards to the commercial side, people will still eventually gravitate back to London. Whilst people enjoyed the lockdown initially, some people now just want to get back to work. So I think that the reality is that people will gravitate back to London, and the rental market will be strong, but I still feel it probably doesn't make much financial sense unless you get the bargain. Do I know or foresee of any tax rebate schemes to encourage property purchase for UK taxpayers? No, I don't, if I'm honest, and probably I'm not the best person to ask either. That will be a tax specialist, but no, I just can't see of any tax rebate schemes to encourage property purchase. As I say, most people now will do it through a limited company. They tend to have more benefits, but again, that's probably better to speak to your independent accountant, tax advisor, because it depends on so many circumstances, like your personal circumstances. What do I think of the apartment price in London predictions for 2021? Okay, I think I've just answered that. Okay, the earlier answer in terms of zone 1, yeah, again, zone 1, I just don't feel that the residential market will have a bumper year. If I'm honest, it's the chunky prices. I think that you're looking at, as I said, overseas investors where we've got a stronger pound won't be looking. So no, my gut feeling is that I don't feel that you're going to have a bumper year in zone 1. Flat rent in Canary Wharf or East are straight falling. Will the price of a flat in E14 or E16 drop more? Okay, so yeah, they're going to be falling at the moment because people don't need to rent them. They're not working in the city. But of course, come June, I would sort of hold it. Come June, I would say that should come back. We should start to see a comeback where people are renting more. I know in our office alone, because we've been in, people just don't want to do the travelling anymore. People are more concerned about travelling due to COVID. So actually, people are looking to live closer to their place of work. And I think the market will recover in terms of the rental market. But again, as I say, there are so many flats going up in that particular area as well. They're not short of supply. So yeah, even now, I think if you took that property, sold it, and reinvested it elsewhere, I think you'd probably be better off. But as I say, I don't think that you're going to have any problem renting it out long term. What are your predictions with the property market in Birmingham? So yeah, Birmingham's always been a bit of a quirky city for me. It's one that we've never really pinpointed to say, look, this is the best area. We know obviously we've got the Jewellery Quarter, which is the main area. We've got Digbeth. We've got some stuff on the outside. So yeah, there's some pockets of Birmingham that I like. I still feel more comfortable with areas, but maybe that says more about me than Birmingham. Maybe I just know Manchester and Liverpool a lot better. I like Birmingham. I like the area. I just feel that in Manchester we know exactly where the council are investing, exactly where the money's going, and we feel sort of slightly bit more comfortable. But no, I think Birmingham's still a really good market. It's really strong. Ideally, if you can get some short-term lets there as well, it's a good market because you've got an international airport. So no, I think Birmingham's a good market. Outside of Manchester, Liverpool, Leeds, what are your tier 2 cities and towns to watch? So again, if you go to places just on the outskirts of the major cities, so whether that be places like Bradford, obviously in comparison to Leeds, Preston to Manchester, those kind of areas, then there you can have a tier 2 city. They kind of create their own bubble, but they're close enough to be within a driving distance or a commutable train distance from the major city. So if you've got if you're working in Leeds, then potentially no problem. You could theoretically live in Bradford, much cheaper accommodation, and you could do your commute to Leeds. Same thing from Preston to Manchester. So I would head to the major city, and then I would sort of venture within sort of like 45 minutes commute, and that's probably your tier 2 cities. Let's have a look. What are my thoughts on Crewe as a location for purchasing residential or commercial property? Do you know what? And I apologise, I don't know. I don't know enough about it. My gut feeling at the moment with any commercial property is that I certainly wouldn't touch shop fronts, again, for obvious reasons, because we just don't know what's going to happen. You know, at the moment, we're all looking positive for 6 months' time. But if COVID rears its head again, we just don't know what's going to happen. You know, are there any going to be further lockdowns? I don't think there will be now the vaccinations here, but I probably would steer clear of commercial. I would stick to residential. The thing about residential over commercial is residential, people always need to live. However, you don't always need a commercial property, and fashions change. So whereas the high street boomed, you know, decades ago, as things are all going over to the internet, I just see the high street dying off personally. I think everything's, you know, and especially over the last year, that's excelled online purchases, and the high street has just suffered due to that. So I won't buy commercial, but residential, again, as long as you can back it up with figures, then I think you got no problems at all. But I apologise, I don't know enough about Crewe to give a comment either way. Do you feel like Sheffield's on the uprise? I feel like Sheffield's a strong city anyway. I think Sheffield's always been a good city. It's great. It's a great student city. Obviously, we've struggled with student renting at the moment, but it's a great student city. It's very dense. It's small. You know, you can walk top to bottom of the ring road within sort of 7-8 minutes from getting off the train. So I think Sheffield. Yeah, I think Sheffield's a good city. I think that I wouldn't say it's about to boom. It's about to rise. I think it's already been rising. Kelham, you've got Kelham Island there. Again, it's a really chic neighbourhood. I like the city, and I think if you buy there and you buy again in the right location, yeah, you're not going to go too far wrong. Do you specialise in new build or existing properties? Both. So we have new builds. Obviously, the big advantage of new builds is you typically get them 10 to 15% below market value. And of course, you have all the guarantees with it. You have the 10-year structural guarantee, you have your white goods guarantee and everything like that. But the downside is you have to wait for that rent to come in. And of course, there's the risk of things being delayed. So we also have, for people who are looking now, we also have things that are ready, and we're actually getting some really good discounts at the moment because, as I say, we're putting through quite a few bulk deals. So we have stuff that's ready now, already tenanted, and you can simply take over that tenancy. So yeah, we can hopefully fit most people's budgets and most people's criteria. Well, that looks like all the questions, guys. Well, look, absolute pleasure. And as I say, keep your eyes out for the other webinars that we're going to be hosting. We're also doing now a monthly newsletter, which has all of further details in terms of market reports. We also have a broker blog every month. We have a broker of the month who will give their take on the market. So keep your eyes peeled, and if there's anything you need from me, so don't hesitate to ask. This is going to be emailed around. My details are at the bottom of the screen now, and it's been an absolute pleasure, and I look forward to speaking to you soon. Take care.